if you can see my screen, CQG IC screen, and if you can hear my voice, please type Y. Much like Deutsche Bank's read, the first thing I'm going to start off with today is not going to be about Greece, surprise, surprise, but it's going to be about the Fed and Janet Yellen. And what I'm going to do is put a link in this room here for you to see. So if you go to that video link, you'll see here a clip of Piers back in February talking about the problem that the Fed have when it comes to rate hikes, and this was back in February this year that this video was taken, when all the talk was about the June rate hike. Play the video, have a listen to what he says about the unlikely probability back in February that they would hike in June. Let me just adjust my mic 1 second. Okay, have a look at that video and see what he says about the small probability that he would hike, that the Fed would hike in June. One moment.
In just under 8 minutes' time, we will see the Norwegian rate balance.
Okay, so have a look at that video and listen to how he discusses the low probability that the Fed would hike in June and the rationale behind that assumption. The same really exists as today. You know, one of the problems that the Fed have is that interest rates have been so low for so long. The longer they remain so low, the less able the Fed will be to respond to future market upsets. You know, if interest rates are already at zero, if QE 1, 2, 3 has already taken place without a rate hike, it leaves the Fed with no ammunition to act should there be another economic downturn, which might well be very likely given what we've seen in Asia, given what we've seen in Greece, and I'll talk about Greece shortly, of course. So the Fed have a problem, that's for certain. If you read Deutsche Bank's report, though, this morning, they've got an interesting discussion. They're saying, listen, would the Fed be hiking, or would hiking rates even be near the discussion table if rates had not been this low for this long? And I absolutely agree with this. If you actually look at the inflation data out of the US, if you actually look at the growth data out of the US, if you look at some of the core economic fundamentals, okay, look, the jobs market, that has improved. That's great, fantastic. But if you look at inflation and if you look at growth, these levels in the US are far from where the central bank would normally be when they're discussing about tightening monetary policy. And in fact, if you put this data, if you put the last 4 months of US data in any other period of time, then you would see that actually the Fed have been looking to loosen monetary policy rather than tighten monetary policy. And this really leads to this conundrum that we are in now, that money has been free for so long. The problems that it creates when a central bank tries to normalize rates. There is no perfect time. There is no right time to tighten monetary policy. And, you know, this kind of flies in the face of what a central bank should do. A central bank should increase the stability of financial markets. That's what a central bank should do. But if you have a look, for example, at the Swiss franc back in January the 15th, 2015, can you see what happens when a central bank intervenes over a period of years and at some point has to remove its intervention? The reaction is not small. So the Fed know this. The Fed know that they have to, at some point, try and turn back to monetary normalization. Is now the right time? Well, if you look at the data on its own, no, it's not. But when is then the right time? Yesterday from the UK, we had some interesting comments coming out, again, talking about Fed rate hikes, and the pound had a very strong day yesterday. If I just go to a 15-minute chart here, you'll be able to see the move yesterday of Mark Carney's comments here, really just coming in almost out the blue at 10:45. Mark Carney's comments that rates might have to rise in the UK sooner than what is currently being priced in, and expectations of a higher interest rate environment in the UK are correct. This was the pound's move here. What's quite interesting, if you look at EB on CQG, have a look at how the euro moved against the pound yesterday. We had a significant down day in the euro versus the pound yesterday, and we're trading at interesting levels, I believe. We're below now the technical level, which was the May low. The next level that we have in the euro versus the pound is at 7,000. And you can see not only is that a nice big round number for it to be a technical level, but also that's the exact low that we hit in June. 7,000 in the euro versus the pound. If I just shorten this chart slightly, you can see a wider trend here. 2015, we've really been chopping around in this euro versus the pound, but just there at the end of 2014, we have another interim level here at 70. No, it's not quite 215. It is, where was that low? Yep, 70.145. Below that, obviously, we've got 70. What does 70 mean? This is number of pence in the euro. So only 70 pence is needed to buy €1 at the moment. If that breaks through the 70 handle, and I can see significant downside here, we're going back then to sort of pre-2007, 2008 levels, where you're talking about 65 pence buying €1, and then we're going back towards the inception of the euro. The euro is not really that old, going back to 2000, 2001, where you're talking about 60 pence buying the euro. If that's going to be the case, then obviously that makes any British purchases in Europe, whether it's houses, whether it's companies, whether it's holidays, much, much, much cheaper indeed. So Yellen has an interesting dilemma. She hasn't taken September off the table yet, although given the financial turmoil at the moment, I would be surprised if we do get September rather than December, but stranger things have certainly happened. We had poor retail sales data coming out of the US yesterday as well. More bad data coming out of the US. Broad-based softness across the board, with the June headline at minus 0.3 month on month, minus 0.3 versus expected plus 0.3. Ex-auto and gas month on month plus 4, month on month plus versus plus 4 expected, minus 1 month on month for retail control. So bad data coming out of the US. Asia stabilized somewhat yesterday, but still they have had a torrid couple of days after the rebound on Thursday and Friday. I don't think the story in Asia is over. And now let's come to Greece. So I don't know if anyone read the Times yesterday. They had perhaps one of the most interesting double-page spread overviews of this deal that was agreed over the weekend. And I say deal with sort of rabbit quotation marks, saying deal. Was it really a deal? And they were talking about. Now I'm quite a Germanophile. Angela Merkel is one of my favourite people in the world, and I have a lot of respect for her. However, you see, when it's come to Greece over the last few weeks, she's been playing it quite softly. She's been allowing Schäuble to do most of the aggression. She's been allowing other members of her party to take the harder stance, and she's been softer. But over the weekend, over 17 hours, she, minute by minute, hour by hour, debate by debate, totally destroyed Tsipras and punished him for what he's done over the last 6 months in terms of wasting everyone's time. He has agreed to selling 50 billion euros of state assets. such a decision would have been absolutely out of the remit of Syriza. Selling state assets, not only is this selling state assets, which is something they go against. If you imagine this left-wing party, they're totally against privatization anyway. These assets should belong to the state, not to the private sector, and definitely not to the private sector outside Greece. Even though these funds are being held within Greece, they're being monitored and held by external bodies. That was one of the debates, whether it will be held in Luxembourg or in Greece. The things that Tsipras has agreed to, I would feel incredibly let down if I was Greek. I would feel let down by the fact that the Europeans, France are hailing this as a victory. It absolutely is not. The hardline Europeans have managed to get Greece to agree to their worst nightmare. And what tends to happen in history, if you look back over time, when you force somebody to do things against their will, I mean, this is kind of like, after the Second World War, we had Maynard Keynes as our Tsipras, if you like, and he was debating with the US in order to try and get some aid for Britain to get us out of our economic quagmire after the Second World War. And the package that we finally agreed to in Britain ensured that the 50s, 60s and 70s were almost disastrous economic times for the UK. We got a terrible deal. And here, Tsipras has got a terrible deal. It is not a success in any way, in my opinion. And it's almost as if, you saw Schäuble, I don't know if you read today, he was saying at least half of his party would prefer a Grexit. And I think that's being shown in the deal that they have forced on Greece, because this is such a bad deal that either they take it and try and implement it, and Troika find out that it can't be implemented, it can't be sustainable, and they're out, or they choose to leave now. I don't think that Hollande should be seeing this as a success at all. I think privately, Hollande is aware of the fact that this is no deal. It's actually far from a deal. So this is my view on Greece. Obviously equities are buoyed, and it's understandable that they're buoyed, but I don't believe this is quite the pill that the Greeks were looking for. And you've got more support coming today from the IMF saying that the only way to deal with this, the only way to get through this, is by debt relief. But there's absolutely no way that Germany or Finland or the eastern states will be interested in debt relief for Greece, not at all. Now, so what happens today when we talk about Greece? Well, obviously the vote to accept this package of death is being put through the Greek parliament. About half of Syriza are going to vote against it, so half of Tsipras' own party are going to vote against it, which immediately then is a significant no-confidence vote in Tsipras himself, so that puts his political stability on the line for sure. It is expected, however, that outside of his party he might be able to gain support in the other political parties, in which case a new government might need to be formed, an emergency government, as an allegiance between the different parties within Greece in order to try and implement these austerity measures. Can you imagine the bureaucracy, the discussions, the debates, the lack of clarity now that we're going to move into a multi-party Greek system rather than one party? I mean, it's just a disaster. If the Greeks then vote it through, then the Europeans have to accept whether to accept their vote. Okay, so this is the process that we're going through. Now, if you look at the top countries in terms of what one countries can veto this going ahead now, what single countries can veto, well, they need to own over 15% of the economic liability of Greece, and 3 countries that do that are Germany, Italy and France. So if any one of those countries do not accept the Greek vote to implement this, then no deal. If, however, it is a country such as Finland that do not accept this implementation, then it can still go ahead because they do not own 15% or more of the liability here. So on the timeline, the Greeks are discussing it within the hour, but we don't actually get the vote till 10 p.m. their time, which is 8 p.m. London time. Okay, 8 p.m. London time, we find out whether this has gone through or not. Now, the Greeks that I've been speaking to seem very confident that this will be voted through. But I don't know. I mean, it's just so bad, this deal, that they're either going to vote for their demise, long, slow, painful death, or they're going to vote for their demise quickly now. This is not a good situation to be in for poor Greece. Looking ahead then for the rest of the day, guys, we've got quite a lot of data. Obviously this morning we've had the CPIs that you've had already. Yellen, she's going to be speaking, that's at 3:30 London time, so that's very important. 3:30 London time, there's going to be quite a bit of action. Now I know we have a flow trader session today. It's a very useful session for you guys in months 1 and 2. So it might be that can be finished by 3:30. Let's see how we do on that. Empire State Manufacturing, Industrial Production, Capacity Utilisation, Fed Stage Book, all coming out today. So we are not short of data, that's absolutely certain. I'll just bring the calendar up here so you can see a bit clear. Empire Manufacturing 1:30, Industrial Production 2:15, crude oil inventories, as you would expect on a Wednesday, coming out at 3:30 London time. And oil, of course, has been interesting given what we've seen in terms of the deal for Iran. I actually have more faith in the Iran deal than I do the deal for Greece. Let's put it that way. So very interesting times. Data heavy today. Please keep an eye on your calendars. Keep an eye on what's going on. Stay responsive to the news. Stay disciplined, of course. And I wish you all the best for an interesting session. Good luck, guys, and have a good day.